welcome back. You know, to say that somebody is your hero doesn't sound right when it's a she. But the word heroine, it's just never settled with me. So let's just settle and say Ivy Zelman is a hero of mine. I was largely, the running joke inside the Fed was that they hired me to shut up about the housing market that was going to crash in 2005. And I was very unpopular, but there was somebody who was even more unpopular, and in a good way, because she protected all of her clients. She protected the broader investing community. So I'm so pleased to bring to you today Ivy Zelman. Zelman has her own research company. She has for years, but she's a legend on Wall Street. And before we get into kind of the CV, if you will, I'm going to share a personal anecdote with you and with Ivy that is likely to blow Ivy's mind. So when I was 16, I was a young graduate of high school. And when I was 16, I was accepted to the NYU Scholars Program for journalists in New York. So that was my great dream, to go back to New York. I had family in Connecticut, and they were going to pay for half of my college. And I went running into my father's office and I said, Dad, I've been accepted and they're going to cover half. And we only have to cover half. And the first summer I get to go to Russia, and every summer I get to travel. It's my dream come true. Oh my gosh. And he said, well, I haven't really filed my taxes for the last decade or so, and there's no applying for financial aid, and you might want to consider community college. And so at the ripe old age of 16, my dreams were kind of dashed. I probably didn't speak to my dad much after that, and because he ruined our family's finances. But I did start off at San Antonio College, and I eventually ended up getting my master's in Austin in finance. And a few weeks in, I was invited by a company by the name of Salomon Brothers that I'd never heard of to go up for an informational interview. I said, God, this finance stuff sounds fascinating. So 2 weeks later, 2 weeks into my MBA program, I'm staring out at a 2-story tall trading floor. And I counted 1, 2, 3, 4, 5, 6, 7 women who were probably sales assistants at the time, and said to myself, God, if a woman can make it here, she can make it anywhere. And I was bound and determined to get on Wall Street, and I did. And I attribute some of my success to how I had to start out my college career. And when you shared with me kind of your background, I have to say I had to pick myself up off the floor. So now you can go and explain to us how there might be a few parallels in that story.
Well, first, thank you so much for having me. It's great to be a guest on your show. I'm excited. And I too am totally admiring your success and everything that you've done at the Fed. And you and I had met back, I think, in 2009, right? We crossed paths then. But anyway, it's great to be on your show and having another professional, successful woman. There's not too many of us out there, so we got to stick together.
Yep.
Well, my story definitely has a lot of parallels. When I was about 16, 17, my dad rocked our world. Unfortunately, his career, which was extremely successful, international banker. We were in London for 3 years when I was 12 to 15. He came back to New York, and unfortunately, things from his role at his company, Midland, London America, it was called, and he wound up losing his job. And so we had, unfortunately, too much money we made, similar to you, where his tax returns showed that we were not going to, in fact, qualify for for any type of financial aid. So I was pretty much on my own, and I wound up going to a city college in New York called Baruch and working full time, actually, for a company a home healthcare company he started. And after a year or so at night school in the city, which I loved, it was a lot of fun. You know, our campus was New York City. I fell in love, and you know, you do a lot of things when you fall in love. And I met a young man from Northern Virginia, and I moved to Northern Virginia. Parents were totally against it, but went there and started out at what's called Nova, a community college like yourself. And after 2 years and working full time, going to night school, I transferred to George Mason, and all in finished my undergrad in 6 years, and had a bunch of student loans, and then really was working my last 2 years. I think I worked at Arthur Young, which now is Ernst & Young. And I was an administrative assistant. And I kept asking everyone that worked there, do you like your job? I'm majoring in accounting because that was what my dad did, and figured I'd get a job that way. And they're like, oh, you don't want to be an accountant. It's like the worst job ever, which kind of, blew up my whole future. I wasn't sure where the hell I was going to go. And they said, go to Wall Street. So I started just networking, and it wasn't that easy. So pretty much anyone I could meet within Arthur Young or anyone at my gym, I just start talking to people, and eventually got a interview at Solomon Brothers. But before that interview at Solomon, which the partner at Arthur Young actually helped me because we were their auditors to get that interview, I actually went and had an information interview similar to yours with Merrill Lynch. And that was a friend through the gym that got me in there. And he was great. And he was actually in fixed income. He was a VP in fixed income. And the first thing he said to me is, do you have any other, interviews scheduled on Wall Street? I was very proud. Yeah, I have an interview at Solly later today. He goes, really, tell me about Solomon Brothers. And so I knew from reading at the time, going to the library, reading the annual report, well, the CEO's John Gutfriend. He goes, John Goodfriend. And then he started going through this rant about everything. Solomon's the brains, Merrill's the muscle. And and then at the end of the interview, he's like, where's your journal? Is there a tombstone? Is there any tombstone of Solomon today? And I'm looking through my briefcase, and I have like my international marketing notes I'm studying for. And I go, I don't have a journal. He says, you better get your ass out of here, get a Wall Street Journal, and see if Solomon Brothers has any tombstones today. So I'm feverishly in the cafeteria at Merrill Lynch. I grabbed a paper, and sure enough, there was a UPS senior 200 million senior note offering that Solly did. And so when I had my interview at Solly, it went really well. Oh, Solomon's the brains, and Merrill's the muscle. And I was repeating some of the things that CJ said to me. And then at the end of the interview, I said, oh, by the way, congratulations. I see that Solly did a 200 million senior note offering. And the guy has touched his chest, and he's like, that was my deal. And he's like, that was my deal. And I go, wow. And that was it. Got the offer. So worked in their investment bank.
Awesome.
Yeah, for 2 years. And I was one of 3 women out of 70. And it was quite intimidating. And most of everyone there, excluding myself, was either at top schools or Ivy League schools. A lot of them were poets. So they really weren't familiar with accounting and finance, because they wanted young people that could really think. And so in the classroom with, we had a 6-week training program. I was raising my hand all the time. And it turns out that a lot of these kids, I was so intimidated by them, they later, 15 years later, like, God, you really intimidated the shit out of us. I'm like, really? I'm like, I was so totally overwhelmed, intimidated by you. So anyway, that was my first 2 years prior to moving into research. And just really quick, I figured I'd go back and get my MBA, because 90% of the kids that are in this program, 70 kids, they usually get 2 years under their belt, they get their MBA. And so I got my GMATs, did my essays, and applied to Harvard, Stanford, and Northwestern. And I said, you know what, if I can't get into one of the 3 best, I already have student loans, I'm not going to go get my MBA. And I got rejected from all 3. So I was pretty deflated. And then I just started looking internally for a job. And Solomon, as you remember, had the big treasury scandal right around that time in 91. And John Goodfriend was out, and Derek Mon was in. And we had a lot of people that thought Solomon was going to have their lights go out, that they weren't going to make it.
And who was in charge at Treasury? Who was the man in charge of this at Treasury? Trivial Pursuit. Jay Powell.
Jay Powell. Oh my God. That's
Jay
crazy.
Powell was the guy who was charged he was an undersecretary at Treasury at the time, and his job was Solomon Brothers. Wow. Anyways, small world.
Very small world. So I just started looking for a job, and the analyst that covered airlines, because I was in the transportation group, that's where I got my job in corporate finance. He helped me get an opportunity to work as an associate under the SNL Fannie Freddie analyst, Bruce Harding. And everyone said, oh, you don't want to go work in research. Those are people, just monkeys. They just do whatever they write whatever managements tell them to. And I just need to pay my rent. So I was just happy to get a job. And that 30 years later, here I am. So that's how I got into equity research and following housing. I actually did get to go through the MBA training program when Solomon, to their credit, the director of research, realized that I was a little over my head. I didn't have the experience or maybe the knowledge that I needed to really be an analyst. And they decided they would take me out of the role as an associate, now being given the home builders and the housing stocks in general, and go to the MBA training program that Liar's Poker was written about. So
Right.
that was pretty cool. And I was intimidated because those people were coming in and they knew their finance. So it was a little different, but it was a lot of fun. Those were the good old days.
Yeah, my first night in the MBA training program, I met Liar. I didn't sleep. I read Liar's Poker all night long because I was the only person who hadn't read it. So you mentioned SNL. If you can, I mean, you weren't really active in the industry at the time, but there was back then a market clearing, a true market clearing.
Yes.
And so hold that thought, if you will.
Mm-hmm.
So you're a full-blown housing analyst. I mean, you're in the II polls, you're out there, you're competing, you're in the trenches.
Yes.
When did you sense the presence, if you will, of Alan Greenspan, or did you ever? And his measured approach to raising interest rates and the follow-on effect that this was having in the housing market?
Well, my first memory is February 94. I think that was when we first had, the Fed at that time wasn't providing a lot of transparency. You know, when they changed rates at an FOMC meeting, that's when we knew it was happening. And I remember that period we had, I think in 94, it was probably 7 in a row tightenings.
Oh yeah.
And it rocked my world because at that time I didn't appreciate the importance to what the equities in the housing stocks, generally speaking, anything tied to housing, were just completely inversely related to the rates backing up. And so I actually published a report completely wrong, you know, the battle between fundamentals and psychology, meaning that, you know, housing could withstand a backup in rates. So that was my first memory of him. And interestingly, a decade later, Alan Greenspan in February 04, I guess that's 2 decades later, right?
No, one later.
Decade, sorry. So I remember in February 04 when he said it's okay to get an ARM. And that's when the market went haywire.
I remember that.
And that was like, okay, so you no longer, you know, really touting a 30-year fixed mortgage rate. And that was the beginning of permission to the mortgage industry to go out there and start these exotic mortgage products. So somewhat interesting that it was a decade later.
It was. And of course, at the time, who was running the San Francisco Fed? And all of this was happening in her backyard.
Well, our friend Janet.
Yes, indeed. That's why I've got this lovely hashtag on Twitter, hashtag J&J, A&D in between, so I don't get sued by Johnson & Johnson. So you saw what was coming. I mean, I'll never forget. I was in a CLO meeting at Credit Suisse in 2001, and a bunch of investment bankers up at the front of the room, and they're talking about this equity tranche. And I'm back of the room, you know, just making trouble. Who the hell would buy that crap of the equity tranche? I asked. Years later, Bloomberg Business Week had a front cover story on that CLO and all of the shenanigans that had gone on in order to build it out all those years ago. But when there was a famous scene with you and Toll Brothers.
Yes.
And what was it like? I was friends with David Rosenberg. I was friends with Jan Hatzius at the time. Mortgage equity withdrawal, house ATM, blah, blah. But what was it that struck you as being kind of, wow, this is an undeniable red flag?
Well, fortunately for me, I have built a proprietary network of industry executives, C-suite executives that are home builders, mortgage originators, land developers, real estate brokers. And over the years, you know, back in 2004 and 5, they were waving a lot of red flags. They were saying that, you know, the level of demand is not sustainable. Builders are buying land that I can't pencil. I can't justify the returns. The mortgage originators started telling you about things like, you'll remember Countrywide's Fast and Easy program, where, you know, basically I talked to a mortgage originator I had lunch with, and he said, yeah, I just underwrote a loan for a law student grad, and he doesn't have a job yet, but he bought a house. I said, how can you justify underwriting someone without a job? He's like, oh, it doesn't matter. I'll just sell it to Fannie Freddie. It's, you know, and all of these things that were, you know, percolating coupled with the data that we're looking at on affordability. And what we really saw is that the primary buyer had pretty much already started decelerating in '04, and that all of the lift was coming from investors.
Mhm.
So we actually published a piece in July of '05 that was called Investors Gone Wild. And it was really laden with the exotic mortgage products coupled with the percent of investors that were going in and purchasing with, liar loans and no money down. So I think that was really for us just red flags everywhere, and it was almost too obvious. And yet you had the industry that was the cheerleaders and drinking the Kool-Aid, back to Bob Toll, where they were like, the demographics are, secular changes and home ownership rates, and this is sustainable. And they really genuinely, most of them believed it. And that was really just very much, I was the sober person at the party. I was not, the fun person that was kind of joining in. The equities were all, continuing to skyrocket, and it was tough. Even my own firm at Credit Suisse, I was there for a decade after Solomon. I was at Solomon for 8 years. A lot of people were like, look, maybe it's time you just, got off the bearish train because it's not working. And then even when I got vindicated, my vindication was really when New Century filed for bankruptcy in March of '07.
Yep.
And that was like the one pivotal point where really the stocks had already gotten killed back in starting July of '05. We started seeing inventories rising. But it wasn't until really the back half of '05 and into the first half of '06 that the equities got pummeled. And it was September of '06, you mentioned Bob Toll, because they had a conference call and he basically said that Washington's getting better and we're seeing improvement. And that's when I said to him, what Kool-Aid are you drinking?
Uh-huh.
The famous quote. And yet the stocks rallied from September through December. They probably were up over 40, 50%. And I put out a report in December of '06, 10 reasons to sell home building stocks, and downgraded all of them. I'd been neutral at that point. And, it was not until New Century in March of '07. And that vindication was really at the first turning point I had that really, that was, sort of evidence that this was really going to be even way worse than we had thought. But up until then, I remember when we did the, the Bob Toll conference call and the stocks rallied, one of my internal research colleagues was like, you really need to upgrade stocks and not be bearish anymore. You're going to ruin your career. And this actually wasn't someone in research. This was the head of product management kind of warning me I'm going to ruin my career. And I went to my director of research pissed off. And so I stuck to my guns. It wasn't easy. I had a good team, but it was really the industry network. It was these executives that are still friendly with many today that kept me grounded, and my fundamental analysis was right. I even shared it with the Fed. I told people at the Fed the things that we had, showing our slide deck, sending them Investors Gone Wild, and they didn't want to hear it.
Oh,
They
yeah.
didn't agree with it.
Back then, you had this kind of shadow inventory. I remember you tracked this shadow inventory kind of in real time.
Yeah.
And yet some other element, and this comes back to the Fed, there wasn't, I'm going back to the RTC, there wasn't this clearing.
Right.
There never had to be a clearing. I was inside the Fed when this cottage industry was born, and income, the deep pocketed, price agnostic buyers. What effect did that have then? And looking way out, what effect do you think it'll have ultimately?
So you're talking about when the RTC basically allowed the ability to clear the land that was.
No, I'm contrasting single family rentals. Okay. The advent of them coming in. I understand that we had a foreclosure crisis, more than 10 million homes. Right. I'm not insensitive to that, but it was nothing like what it could have been.
Correct.
Because you did have free money at the time. You did have the Federal Reserve step in. You had the advent of quantitative easing, zero interest rate policy, and now there's all this money. Right. And this money is moving into Phoenix and the Inland Empire and the Sand States, what we used to call the Sand States. So,
Tile States, Sand States, right?
But what was that like to see? Because you've been following this industry for basically your entire career, and right. Here comes a whole new asset class, a whole new player.
Right. And it really, when you think about the single family rental market in 2010, I remember talking to a property manager, one of my real estate brokers that actually managed single family rental properties. And I was like, oh, people live in single family homes and rent them. Like, it was like a new concept to me. And so we started really digging in, and he's like, well, absolutely. In fact, I'm a member of the Single Family Rental Property Managers Association, and there's 3,500 members. And so it really was what we called, we entitled a research thematic report called The New Old Thing, because it really wasn't new, but it's new to the institutional investors. So what we started seeing is institutional investors that, looking at land prices in Phoenix that had pummeled, and, you could buy land at, pennies on the dollar, that were coming in and buying up these foreclosures at, really compelling prices that were, really contagious. So the industry started seeing, I remember doing a call with Blackstone, and Jonathan Gray was like, do you think that SFR is a good asset class to contemplate? And I was like, absolutely. You're buying below replacement costs. So you're buying all these homes, and not only will you eventually get HPA, but you also can get pretty good cash on cash returns. And we started realizing that this was going to be the next wave. This was going to be the ability for a clearing mechanism for a lot of the inventory to start to get acquired. And it wasn't just the institutional investors. There were what we called our reluctant landlords that couldn't sell their homes, that decided that they could, be forced to try to rent them out. And then all of a sudden they were renting them out, and they liked their cash on cash returns. So the inventory started getting acquired and continued to clear, and it was contagious. So the industry developed into this now very similar parallels to what was a mom and pop industry in the multifamily space in the mid to late 90s, became institutionalized. We are now in that institutionalization of the SFR space, and it's still pretty negligible. When you look at the size of the industry, there's 16 million renters, and only roughly 2% is really held by institutional investors. So it's concentrated predominantly in those smile states, in the sand states, maybe more like smile, because you think about Atlanta. Atlanta's a big SFR market. You've got Texas markets across the space, the Carolinas. You've got the mountain states, Nevada, Phoenix, and of course in the inland parts of California.
Up to COVID, we had seen an extraordinary run in housing. And I think, absent the actual economic cycle itself, one of the reasons was probably that lending standards were the tightest in the history of mankind coming out of the crisis.
Right.
And that lasted for how long?
Well, when you think about 2009 was officially the first year of a recovery, and we had a lot of stimulus that was being thrown at the housing market at that point with the Obama administration, the first-time buyer tax credit, and we really didn't see improvement despite affordability being at that point an all-time record high. So 2009, 10, 11, housing was still really on its ass. It wasn't responding to record affordability, and a lot of that came because the mortgage industry had been arrested. It wasn't allowing. So you can have a theoretical affordability, looks great, but if the lenders aren't going to lend, so the credit was very stringent. So we do a proprietary mortgage survey that captures about 20% of the mortgage market, and we ask on a scale of 0 to 100. 100, you can't get a mortgage. 0, you can fog a mirror and get a mortgage, and 50 is normal. Where are you on the underwriting stringency? And I remember that the stringency peaked at nearly 80 on that index in 2012. So the 2009 to 2012 timeframe, the stringency actually got more intense leading up to Dodd-Frank's legislation in January 14 to providing the rules of engagement. No one trusted the government. No one in the mortgage industry felt comfortable that they weren't going to have these loans being put back to them. And the rules are kept changing. And there was a lot of uncertainty, and the mortgage industry didn't like that. But starting in 2013, the credit overlays started coming down and really continued to, as the industry started getting more comfortable that home prices were rising, that we now had guardrails because of QM with CFPB. There was more certainty that the industry started getting more competitive, but it was really the non-banks, because the large banks, the banks, they didn't want anything to do with FHA. So they're pretty much, you talk to Jamie Dimon, you talk to Brian Monahan, they're not going to do FHA. So the non-banks really went from 20% market share to over 60% market share currently. So you went from 0 to 100 for non-banks, picking up the slack that the banks weren't willing to do on FHA. And FHA was really the the bulk of the market in terms of where the industry with the credit box being so much more reasonable. So really by 2019, the stringency index I referred to was back to like 54. And so that's really normal credit box. So you talk to the guys at Fannie and Freddie or at FHA, you say, look, these guys are not lending to the full extent of the box that we offer. So you can go 580, 3.5% down. So wasn't until really, I'd say 19 that all the overlays were gone completely. But then because of COVID, that stringency index shot up because of forbearance and all of the risk then that the mortgage lenders were starting to, servicers were like, holy crap. And so it's been elevated still. It's kind of at a 62, 63 right now. And I think that will change if in fact we have rates continuing to back up as inflation, which we think is really rampant. I mean, my ecosystem is ridiculous on fire in every input cost, every piece of the puzzle. And so the idea there's no inflation is just absolutely nuts from my perspective. When inflation actually materializes and the Fed can't control it, it's your expertise, or loses confidence that they can control it, I think we're going to see that there's a lot more risk that the mortgage lenders will start to ease because they're going to need volume because they've gone out and aggressively hired to meet this refi boom and the purchase boom, and they can't keep up with the demand. And so the spreads have collapsed. When you just look at simplistically 10-year versus 30-year, what had been a spread historically at 165 basis points going back 30 years, a trend line, by the midst of COVID, when they were all dealing with the policy to provide forbearance for a year and the backlash of that, the spread shot to 270. And now the spreads have pummeled to 155. And that's really a function of them willing to give up their massive gain on sale margins to continue to see the volume at high levels. They're willing to give up price so they can sustain volume. And if the industry gets more competitive because interest rates are backing up, you will see more and more easing on that stringency scale, that 0 and 100 that I referred to.
So this is where we cross over into kind of counterintuitive land.
Okay.
And some of the parallels that take us back to New Century and Countrywide, and when volumes were so critical, because I remember my friend Michelle Meyer, when she was barely an economist, just a young pup at B of A, and she was like, 40% of the jobs in America, indirectly and directly, are tied somehow to housing. And the indirectly was a big indirect, but there were still a ton of people who were tied to the housing industry. And if there's one thing that we've heard in the last 8-9 months, it's that the area of mortgage lending in the labor market is just on fire.
Crazy. Absolutely.
But those anecdotes have dissipated in the last few months.
Yeah, you don't hear as much, but I'd say that they're still hiring. I think you've got a lot of people that can work at home, remote, doing collections, and there's, that side of the market with, or the proportion of the industry that's really on the servicing side and collections because of the forbearance problems that, right now are not really an issue for the housing market, with 2.6 million borrowers that are struggling to make their mortgage. So they're busy trying to collect. So they're still hiring in that area. They're not as much on the front end, but on the servicing side and collections, it's really continuing to see more and more hires. And I think that the industry is concerned just because as we think about the commodity aspect of it, I mean, you can differentiate all you want, talk about your technology, but at the end of the day, the consumer is going to look for the lowest rate. And so UWM, which is the largest wholesale lender, recently lowered their rate sheet by 1.5 points, and just like, boom, we're going to take the volume. And then you have Rocket, and then you have all the banks. So the retailers are the last to lower rates. Non-banks will go first because they don't have the same capital position. So it's just fascinating to watch. And right now we're seeing things moving very quickly.
Well, okay. So speaking of quickly, what was kind of home price? By the way, HPA, home price appreciation, FYI. What was home price appreciation kind of when it was like the zenith of the housing boom years? And compare that to where we are today.
Yeah,
home price appreciation was.
The home price appreciation really started accelerating 2000, to 2003, and it was really 2004, I think, was like the first big year. And I can't recall if we were 9%. We wound up in double-digit territory, for consecutive years, 2005 and 6. But I think that what I see parallels today is that when you think about that level of, 2010, 2020 finished the year up 10%. And right now, just looking at seasonally adjusted numbers and our proprietary home building survey, we're looking at 13, 14% annualized price increases, seasonally adjusted. And so what I would tell you, what's concerning from our perspective, is that there's a lot of assumptions going in to the front end to acquire more land, whether you're building on the land for sale or build for rent, that you have to justify using the same level of price that currently is where we are today, and the sales pace to justify underwriting at today's inflated land prices. That has a lot of parallels to what we saw in 04 and 05, when you were getting silly and stupid about some of the underwriting that it didn't pencil. And those are things that we're seeing that are our yellow flags right now in the market. Mm-hmm. And I think for the most part, builders, the most interesting thing that we're seeing is that the demand is so strong that they are limiting releases of product because they don't have enough land to replace the land that the communities that they're selling out of. So rather than push on the pace and extend their backlog, which has risk because of the inflation in all the building materials and in labor, they're just stepping on the gas and raising prices. And doesn't that remind you of 2013? Mm-hmm. Because the builders got so egregious in 13 and they were limiting releases and they were stepping on the gas until, guess what? We had Bernanke in May go away. And that was when rates shot up 100 bips and the world stopped.
The taper tantrum.
Yes, taper tantrum. So there are a lot of similarities that, we can draw. And yet, the difference though that I see is that the inventories in the United States right now are at all-time record low. And the way we think about inventories, just to put some quantification around it, is for single family inventory, both new and existing, which is, majority existing homes divided by households. So we can look at that ratio, and historically that ratio, call it trend line, is 2%. And right now we're closer, and historically back to the previous boom, I should call it a bomb went off when inventory exploded, we got to almost 3.5%. Mm-hmm. And now we're currently close to 1.1%. So we are at an all-time record low, and pre-COVID we were at a record low. But that was surpassed because all these people pulled their homes off the market. Interestingly, it's still down 25, 30% from where we were pre-COVID. So inventories are so tight. So there is a need for more production. There is a need for more shelter. But the question is, what will the margins look like? And what the appraisals are showing? Like the appraisals are not keeping up. So anyway, I'll stop because there's just so much there. And we are seeing just, there's so much fatigue in the market, fatigue from the trades, fatigue from the supply chain, that it's exhausting, and they're running at 100 miles an hour. And in my opinion, we're running at 100 miles an hour and starting to get on dangerous curvy roads, and it's not going to end well. It may not be a great financial crisis where we're going to have the kind of crisis we had in 2000, no means, in my opinion, in 2007, 8. But I do think that there's going to be a lot of risk for the industry and some of the companies that are getting a little bit loose, fast and easy again.
So a lot of that inventory disappeared. And at the same time, you had a big chunk of a generation move in with their parents. So, what's to say for, Italy does it, a lot of countries do it, but do you foresee, in terms of headship rates, do you foresee kind of a sustainability of multiple generations living underneath one roof?
I think that the data suggests that there was a lot of young adults aged 18 to 34 that, despite being 34, people are surprised to hear that actually did leave their, having their rentals and moving back in with their families. And while unemployment surged during COVID, that really surged alongside of it. We've started to see that wane a bit as we are seeing young adults leaving their families to go back into cities and start renting again. I have two associates, 27, that lived with their families in Livingston, New Jersey. Alex and Jesse, call out to them, and they're now back in the city. And by the way, they got great deals on the rentals. That
Oh, yeah.
one in Hudson Yards, like 25% below where it was pre-COVID. So good for Jesse, bottom ticket. But I think we're going to see not a snapback, but we're going to see those that are employed that were working remotely that went to live with their parents. You'll see that decoupling. But we still have many young people that are out of work. So whether they're in hospitality, leisure, entertainment, or travel, all those things, all those jobs that unfortunately COVID resulted in them being unemployed, how quickly those industries come back. But if you're living at home and you're doing well and you're productive, how many employers are going to let you to continue to do so? I think you're going to see that work from home, which back pre-COVID was, call it, in the mid-single digits. There's studies that are saying that it can go to 15 to 20%. So I think that household formations, we think, relative to the housing vacancy data, just overall Census Bureau data, we are much more negative on household formations for what occurred in 2020. We estimate only 900,000 actually incremental households were formed, and that compares to kind of running at 1.3 million, 1.4 million because of this consolidation that you refer to. 21 at this point, it's tough to say what the number will be, but it will be below that 1.314, which is a lot of what the overall housing industry is dependent upon when they're looking at, well, we're such in a deficit of supply, because there's only two components to really determining the need or how much supply we need: household formation plus demolition. So if household formations are not going to be 1.314 and demolitions kind of run in this few hundred, call it 200 to 300 range, then you're going to see that we're building at the expectations for 1.5 million we need, when maybe we don't need 1.5 million. So at some point we're going to overbuild. We're not overbuilt yet, but I would say that we're going to, within the next few years, I could see that we would be oversupplied again. So it's going to be interesting to watch.
Yeah, here in Dallas, I figure the final exurb is going to be, across the Red River and inside of Oklahoma. Time they're all finally said and done. So there has been something else that you've also never seen in your career. There are a lot of 2020's word was unprecedented. This mass exodus out of the densely populated urban centers. You've even got you've got a term that the Great Reshuffle.
Yes.
Talk to us about where we might be given. I looked at a map of the United States yesterday, and mobility is increasing in all 50 states plus DC. You've got basically green lights even California is starting to, Disney's going to open up, for God's sake. We're like, I can see the finish line. So where do you see us as being in that cycle? And talk also about this wave of second home purchases.
Right. Well, first, on the Great American Shuffle, what we should all recognize, actually, even before the Great American Shuffle, let's talk about the flight from urban to suburban to exurb. What we have been witnessing and reporting on is that trend had been well underway, really starting in 2015. And a lot of it was predicated because of millennials were becoming of age to get married and start families. So lifestyle really was already accelerating the flight from the urban core to the suburban, and even more so what we call the exurbs. This is the third furthest ring. And so if you look at an index that we have called a GDI index, and we love indexes. So a 0 is the most rural, out in Oklahoma, that's your 0, and 100 is New York City. Mm-hmm. And so when you look at this index and look at where the adult population lives, from 2012 to 2019, pre-COVID, we had a 45-point drop in the above 45 plus on that index, mm-hmm. and a 27-point increase in the 0 to 9 or to 9. So that continuum was already showing this shift, and it was because the number of people that are aged 35 to 44, which is really that cohort that is going to more likely be married with a family, that in 2017 is going from a trough of, call it 40 million. And by the end of this decade, 2030, be 48 million. So as compared to the 25 to 34 is peaked in 2014 and has been decelerating. So it's a lot to do with the underpinnings of the demographics that started this urban or the deurbanization. Now you get COVID. So all of a sudden you've got young couples that might have thought they're going to live in the city for a few years. They haven't started their family yet, but that we've pulled forward people leaving. But more importantly, we haven't had the incremental people moving into cities that you normally have. So the combination of the two, the pull forward of those leaving to, flight for, more space, flight to, safety and having their own backyard was magnified by the lack of people coming into cities. But the Great American Shuffle has been underway for a very long time, going back, really looking at just this prior decade, for example. We estimate, although the decennial survey is not completed, that households grew about 9% from 2010 to 2020. If you look at the red states predominantly, we'll look at Texas, Arizona, Nevada, Idaho, Utah. Those states, including Florida, grew anywhere from 18 to 20%. And so then you look at the flip side with a lot of our blue states, California, New York, New Jersey, Connecticut, Illinois, Ohio, growing at 2 to 3%. And so that Great American Shuffle was well underway. Now you get COVID and mobility rates. Interestingly, you mentioned that. If you look at just simplistically, just take 2000's mobility rate and compare the mobility rate to where we were at 2018, you were down about 400 basis points. So we were seeing that people had historically, because boomers, which are a very important cohort, bigger than millennials roughly, and also more importantly, much bigger from the incremental change from the prior generation, they age in place. So, I'm 54 and I have been living in the same home for 15 years and we're not planning on going anywhere. So the older we get, 9% of the people that are between the ages of 50 and 54 move in a given year. When you're 20 to 24, 53% move. So we have an aging population, which tends to age in place, which is why mobility was under pressure. Plus, because of the great financial crisis, a lot of people lost so much equity in their homes and they didn't have enough equity to trade up. So discretionary move-ups were just really lackluster, which was another reason why inventory was not, after the great grab from all the investors and the iBuyers, you've got so much demand beyond primary buyers that inventory cleared and hasn't been coming back because the lack of discretionary upgrades, because of the aging population, and also people locked in at low mortgage rates thanks to our Fed policy back during the great financial crisis and QE, that people were like, I'm not moving, rates are so low, I'm disincentivized. So a lot of that kept the inventory so tight for this cycle. And as a result of that, people really weren't moving. Then you bring COVID in and now mobility is accelerating and we're starting to see people are going to all of these great affordable red states, and they're not only better, more affordable, but they've got better climates in many cases. So you're seeing that shuffle that I referred to 2010 to 2020 just on steroids now.
So you mentioned baby boomers.
Yep.
We've been studying the labor force participation rate, and for 55 plus, the labor force participation rate peaked out at around 1960. Then you had this long, huge decline that perked up basically with the dot-com bust. So you start to see this rise up off these lows in the labor force participation rate for those 55 plus. It got up to about 40% and stayed there. It's hovered there for a good 10 years. That's been one of the most consistent increasing cohorts into the labor force. Because for whatever reason, longer life expectancy, they couldn't leave the workforce, their portfolios blew up, not once, but twice, blah, blah, blah. In the past, post-COVID, if you will, we've seen that come crashing down to the lowest since 2007.
Wow.
So of the people, and we have not seen that in other age cohorts. The other age cohorts are being reabsorbed back into the workforce. But we are finally seeing baby boomers, instead of retiring in theory, retiring in practice. So given where the stock market is today, is that a potential area that could loosen up inventory in coming years?
We hope so. I mean, the expectation is that we'll see inventory loosening up because people are, the graying of America, the retirees moving from, the cold climates to more favorable climates. Inventory you also would expect to rise as it's a seller's market. People are recognizing that their home values have gone up considerably. And so we keep saying inventory is going to start increasing because people are going to recognize it in a post-COVID world when they're no longer concerned of their safety, they've been vaccinated, they feel like they can finally make the decision. There's also a lot of pent-up demand from a mobility perspective that people are waiting what their firm's policy is going to be. So I was on the phone yesterday with a professional at Goldman Sachs who has 3 children, lives in the city, and she's waiting to know whether or not they're going to allow for her to commute maybe 1 or 2 days a week, and she's going to then move out to Long Island. So she's waiting. And I think there are a lot of people waiting because if you ask firms their policy, they have yet to determine and finalize what they're going to allow their talent to do.
Mm-hmm. Yeah, but I see plenty of people on trading desks who've been, out in Westchester County this whole time, and they haven't skipped a beat.
Yeah.
And by the same token, you've seen an extraordinary pickup in second home purchases.
Right. I didn't mention the second homes. Second homes are off the charts. And why not? We have free money, thanks to Jay. The world has been great, so great to those that can afford to buy a second home because the stock market's also in euphoria. So we've got a wealth creation, the wealth gap between the haves and have-nots, thanks to Jay Powell and QE, or every measure that have resulted in the stock market's euphoria and liquidity, is only fueling more second homes. Now, I don't know if you saw yesterday, Fannie and Freddie came out and basically capped that they're only willing to do up to 7% second homes now as part of their loans that they'll purchase. So they're recognizing there's more risk. So that should start to maybe reduce or diminish some of that fueling. But there's so much above the Fannie Freddie loan limit, going on. So
you would think that would be predominantly jumbos anyways.
Yeah, I think it is. I think it's more jumbo, but just even them capping it is sort of a recognition that there's more risk associated with that. But I think that the jumbo market for second homes right now, magnitude wise, is probably at or above the prior peak levels. We haven't seen this level of demand. And I think, it's going to continue contingent on rates 100%, and the stock market. But really thinking about, today's second home buyer is taking advantage of the ability to work remote, having more flexibility. So it's a very positive story from a secular perspective, the work from home phenomena.
So I'm going to throw out an accounting term here. Last in, first out. There is some concern. We've spoken offline in the past few weeks, and the FHA delinquency rate peaked at 14.4%. After the great financial crisis, it's at 17% today. Severe delinquencies are at 11.8%. I realize this is too big of a question to ever answer for anybody, for policymakers, for politicians, for bankers, for Fannie, for Freddie. But what happens? What happens to a lot of these buyers who've come in? What, 40, 50, 60% of them need down payment assistance. So what is kind of the solution, especially against the backdrop of runaway home prices, when you've got a lot of new buyers in homes that they might not be able to afford? So if you're Janet Yellen, I mean, how crafty, you're going to scare me now, but how creative can that woman get?
Well, first, realizing that the fact that home prices have inflated so much really enables a lot of these homeowners that are struggling to possibly sell their homes and pay off their mortgage and not be underwater. So that, is going to really be a savior to many. So what we're seeing right now with servicers is that they're going to continue to allow borrowers to be modified through September. Right. And then game over. I don't think so. Not under this administration. They'll just extend it and kick the can. And a lot of those people you would hope are going to get back to work. The other thing that the administration is contemplating right now is a first-time buyer tax credit for $15,000 for those that qualify, would have it advanceable and permanent. So that will juice up housing even more. And you also have the dreamers, so roughly 800,000 dreamers that will be eligible for FHA financing. And we also have student loan forgiveness that is being contemplated that would also help for those that make less than $125,000. They're contemplating $10,000 of student loan forgiveness. So they've got a lot on the table. Whether any of those will come to fruition is debatable. But I think that right now, the struggling borrowers, the best thing that they have going for them is really the fact that home prices have inflated so much. Actually, there are companies today that will allow you to sell and stay. So basically you sell your home and they will rent you'll rent the home back. And so you get the equity. So you can't qualify for a cash out refi because you're unemployed. But if you want to do a sell and stay with some of these startups, like a company called EasyKnock, you can do that. So there's ways to get around losing your home. But for the most part, there's so much demand, Danielle, from the iBuyers, the SFR buyers, the fix and flip buyers, that there is literally a starvation for inventory. So because we both know that foreclosures in judicial states, having lived through the pig in the python coming out of the Great Recession, it's not going to all come at once. We're not going to see a flood of foreclosures. It would be very much similar to what we had through the great financial crisis. So I think the market can absorb inventory. It's just for those people that would be unfortunately in a situation where they're forced to sell and whatever, consolidate, move back with family members or friends, or move to a more affordable shelter. It's unfortunate if it comes to that, but I don't think it's going to create sort of a collapse in home prices by any means.
Mm-hmm. So what will your first yellow you've seen a few yellow flags. What, because we don't have a confluence of craziness. There's not the credit rating agencies and the Fed and the underwriting and the CDOs. And I mean, it's not everywhere in your face at all. And this is totally different. You have to more than fog a mirror to get a mortgage. But what do you think will be kind of your first red flag if you had to look into your crystal ball, which nobody likes to do? But going out into 2021, given, I mean, just the sheer heat throwing off of all risky assets, the stock market, and the fact that we're about to pump a few $1 trillion into the economy, a lot of which I think is going to go into services spending.
Mm-hmm. Well, whether we think about the risk to sort of home price inflation and think about the things that concern us, we look at the number of homeowners in the United States that have been the beneficiary of, record low rates to refi and improve their balance sheets. So if we look at a 30-year fixed rate at below 5%, it's shocking that 23% of Americans that own a home have a rate above 5% still. And when I look at those that are that own a home that have a mortgage rate below 4%, is 49% currently. So the reason I frame that is because I'm wondering, who are the people that are above 4% today? And it's funny, I was actually talking with a girlfriend last night that lives in Long Island, and where I grew up, and she is at 4.6%. And I'm like, are you out of your mind? Why haven't you refied? You live under a rock? You don't realize rates are low? She's like, I'm just so busy. No one else is going to take all the data, and there aren't the closing costs expensive. So she was like my one anecdote of someone that lives under a rock, that didn't realize you can refi and save yourself a lot of money. Right. But I think for those people that have been, savvy enough to refi, the 49% that are below 4, and there's roughly 22% below 3.5. And we start to look at those people, what's going to happen if we get a mortgage rate at 4.5%?
They're not going anywhere.
They're not going anywhere. And so I think that to me will really stop the music in the discretionary upgrades for those that are not what I call the affordability busters, those that are leaving those high cost states to go to low cost states that won't care if mortgage rates are 4.5% because they have such a arbitrage. So I think that will be a wrinkle to sort of understand the implications. But one of the things that you call it a yellow flag or not, but think about, whether you're in Dallas like yourself and you think about all the local buyers that are getting shut out because of all of those affordability busters that are coming into their local markets, like Austin, from the people from Silicon Valley. They're kind of making a new mini Silicon Valley in Austin now, or if you're in any parts of Florida, from all the New Yorkers that have come, people from Chicago are going into all of these Sunbelt states. So it's making it much more harder for the very borrower or potential prospective buyer that the administration wants to help, for the people to reduce this inequality gap. we're actually throwing gas on the fire to actually accelerate that inequality gap.
Right. And in the meantime, you're going to have mass amounts of multifamily high rises that I saw some extraordinary number of units that are coming online this year in New York. I'm like, who is going to absorb that? I mean, this, we're not even talking about on the market yet.
Right.
And yet you've had this massive trend. So, I mean, presumably the younger ones are going to come into the cities again. They have to.
I think so. I think so. In the multifamily market benefited from what we call the wall of capital that really chased that asset class, as many refer to it as the tallest midget within commercial real estate, because it certainly was outperforming office, retail, other segments.
Oh gosh, yes.
And yet that wall of capital has resulted, it's predominantly in the urban core. The backlog of units that need to be completed is at multi-decade highs. And it's predominantly in those urban core markets where demand is pummeled, and you have this, perfect storm of incremental supply that still needs to be absorbed. So I think that it's going to be very attractive for renters because prices are still going to be under pressure, and it's just going to make it more compelling for them to actually, potentially young people, come into the city after being for so long so expensive to live in some of the great cities of our country.
Well, that's promising if I was 25 years younger, but it's all good. It's all good. All right. So I have one last question. A friend of mine, she named her boys identically so that she didn't have to, she's from Louisiana, very Southern. You are not very Southern, Ivy. But she named her boys so that they would have all the same initials so that she could use everything that she'd monogrammed. So I have to ask Zoe, Zachary, and Zia. What's with the Z's?
Well, I think,
this is amazing. Z squared. These kids are all Z squared.
They're all Z squared. So when we were pregnant with Zoe, I love the name Zoe. And given that our last name is Zelman, it kind of sounded cool. And then when we had Zach, our middle one, he was going to be either Nicole or Zach. And so when we had Zach, we said, let's just stick with the Z theme. And so we kind of made up Zia. We're playing with names and what rhymes with Mia. Oh, Zia. I remember that one. And I actually have an Australian Shepherd named Zilly. So we took it after a store. So we just like the Z's. So it's been, it does get confusing though, because I'll call, each kid by each other's name. And I actually call my youngest daughter Z or Zia Bia. And it's a lot of fun.
Well, okay, now that mystery is solved for me. So let's do this again in 12 months because your world right now is moving faster than my world, and that's saying something. So I'd love to get back together in about another 12 months and revisit. Maybe you'll be in your other home, but for the sake of all of us, stay out there in Newport Beach, enjoy the sun. Great visiting with you, and I hope to see you in person at some point in 2021. That would be great. Take good care.
Thank you, Danielle. It's great to have being on your show.
Thanks, Ivy. Well, I don't know about you, but I'm a huge fan of the housing market. Ivy is the guru of all gurus when it comes to housing. We know it's something that's front and center for so many people right now because home prices have taken off as much as they are. So tread lightly. You are playing in a market right now that is at all-time highs, just like the stock market. And if you're interested in my views on other asset classes, I just did an interview with Adam Sosnick. If you missed it, please watch it. It's fun. There's actually day drinking involved. I'm not kidding. And if you haven't subscribed, please go ahead and do so. And I look forward to the next time we meet for Down the Middle. Thank you. Bye-bye.